While rising oil has pushed global markets lower on Thursday, tech stocks were crushed under a different question. How much spending is too much spending? Now, shares of Alphabet and Tesla fell sharply after both companies signaled higher spending on artificial intelligence infrastructure. Tesla's stock plunged by almost as much as 14%, while Alphabet ended up losing almost 6% of its valuation, dragging major US indices lower. The trigger was not weak demand or slowing revenue growth. Instead, the investors were focused on sheer scale of spending. And both companies have reported negative free cash flow in the second quarter, raising concerns that AI investments are now consuming cash faster than they are generating returns. Now, Alphabet has significantly increased its capital expenditure outlook for the year, and the company now expects to spend nearly $200 billion in year 2026, up from $15 billion from the earlier projections. And the company has also warned that spending could rise further in 2027 as it is expanding data centers and computing capacity to meet with the surging AI demand. Now, Tesla's spending is also accelerating. Capital expenditure has jumped by nearly 142% year-on-year in the June quarter, and the company expects to invest more than $25 billion this year. And much of that money is in fact being directed towards AI-related initiatives, and this includes semiconductor production and the Optimus humanoid robotic project. Elon Musk has described 2026 as a massive capex year, arguing that these investments could generate some of the highest returns that Tesla has ever seen. And despite these assurances, investors remain very cautious as the AI build-out requires enormous upfront spending with uncertain timelines for profitability. While concerns over spending have dominated the market sentiment, both companies have pointed to signs that their investments are beginning to deliver results. At Alphabet, Google Cloud revenue has surged nearly 82%, while the division's operating margins have improved sharply from a year earlier. And the company says that demand for AI services remains so strong that it still lacks sufficient computing capacity. And the market reaction suggests that enthusiasm for AI remains intact, but investors are becoming much more selective as tech giants continue to pour in billions into AI infrastructure. Wall Street is increasingly demanding evidence that those investments can actually generate returns and not just growth.